if I could please invite on stage all our three speakers. We have with us Mr. Vikram Vaidyanathan, Managing Director, Z47, Mr. William Hockey, CEO and founder, Column, and Mr. Harshil Mathur, CEO and co-founder, Razorpay. Can we have a wealthy round of applause? We're talking about a fintech fest over here. Let's bring the energy back in the air, and let's welcome all our three speakers. Thank you so much for joining us. We're all set for the trialogue, and so are our speakers. So with that, over to you, gentlemen.
Hi, everyone. Super excited to have these two gentlemen on stage. Between the two of them, they've helped build the backbone of technology both in India as well as in the US. So I've been looking forward to this conversation for a while. So thanks for the time, guys. I'm going to dive right in with William. And his background is that he founded Plaid, and then he acquired a bank to now found Column. And so William, just talk us through this journey where you were building sort of like an API platform from the outside. And then at some point in time, you said, you know what, I'm going to build this from the ground up. So talk us through the journey.
Yeah, totally. So I built a large non-bank financial technology company in the States called Plaid. And we were always looking outside in from a regulatory landscape. And there was a massive kind of groundswell of companies building innovation in kind of 2012 plus around fintech in the US. But I started to realize kind of in 2020, 2021, that it was getting quite crowded. There was a huge amount of innovation, a huge amount of players in the space, but actually inside the regulatory landscape, actually being a regulated bank, there actually wasn't a lot of competition. The existing banks in the US had been there for a very, very long time, and they were very much focused on being a full service, kind of like Walmart of banks, in terms of actually starting when you were just in college to all the ways to doing your corporate debt underwriting. And I actually thought there was a market to actually be a platform bank, where what we do now at Column is we're a regulated bank, but we've actually built all of our own technology from the ground up. So physically racking our own hardware at the Federal Reserve to building our own core system, own APIs, everything to actually power non-banks, foreign banks, and anybody that actually wants to operate in payments and deposits and lending in the States. It's been an amazing journey because we've actually been able to start from scratch and actually build bank infrastructure and our core infrastructure with no technical overhang. And that's just enabled us to be way faster, way more nimble than anyone else.
So the context of this discussion is, in India, there's this explosion of transactions on the payment side. And that's just transformed our ecosystem over the last 5-6 years. But the core bank stack hasn't been touched in the last 25, 30 years. And we keep thinking about, is it time to change the core? And we were talking, and you said, actually, we didn't change the core. We actually built a new core, and we're sort of operating them side by side. So talk through that choice.
Yeah, so I kind of started this journey by actually buying a national bank in the US, which had its own infrastructure, had its own core and stuff like that. But one thing we decided to do was actually build from the ground up. And so all new customers, all new business, all new stuff would actually come through a core that we built ourselves. And we actually chose to actually not migrate all the existing stuff over. Because if you think about it from a technical perspective, it's actually quite easy to start from scratch. The hardest thing is dealing with a huge amount of technical debt and a huge amount of legacy infrastructure and trying to migrate that over. And so we actually found it most efficient just to kind of maintain that for the kind of heritage and legacy business. And then everything else, we just built from the ground up.
So Harshil, when you hear all of that, and in India, there are all these conversations, should we change the core? Should we build around it? Or should we just hollow out the core and build some parts of the core outside? How do you think about today? Is it possible to build this new core, or do you keep innovating outside of it?
Yeah, I think in India we have gone the different route. I think what he's saying is right, that a lot of things in the core also need to change. What we have done is we have started segmenting it out, and we've gone top down, where we have started innovating on the fringes first, and then we're going slowly down. So to give an example of Razorpay, when we started the payment gateway, we worked with banks and acquirers and used mostly their tech. And then we built the product and tech layers on top of it, which the merchant integrates. So the API was ours and the integration was ours, but most of the processing was actually happening with the bank. Over time, we've gone deeper. We started through to various routes, we started controlling larger and larger portion of the tech because, as he's right, like a lot of innovation happens in the bottom rails, but you need to get there. So we started with the fringes. We went to the central rails, which is controlling the routing systems, controlling where the transaction is going, controlling the settlement part of it. And then, like last year, we launched, for example, a UPI switch where we control, where we are owning the end infrastructure. So we built that switch, we deployed it in the bank, but when a transaction is originating on Razorpay side, it's hitting our own switch in the bank as well. So we're controlling largest part of that technology stream. And the more and more aspects of technology that you control, of course, there's a lot more leverage that gets built out because then you can innovate on every aspect of that business. It's hard to innovate on just one thin layer, but at least for companies like ours, I think this was a good starting point and then over time go down and segregate out. From an India perspective, I think we have taken that approach that, hey, how can we move a lot of these aspects which are not really core to banking, let's say, and move it out of banking. So like UPI is a great example of that allows the transaction processing and all of that to sit out, maybe in the bank itself, but in a separate infrastructure outside the bank, not in the core part of it, but it still hits the core banking systems. It's just the majority of the authentication and authorization legs sit out of it. The core fund transfer still goes back and hits the CBS. So I think that way we have said that, okay, like let the core be there and control that core transaction processing. And honestly, it's not very bad at that. It's really good at handling high front flows, high volumes, high TPS, but a lot of things which are fairly new, which are hard to add to the core, like authentication, authorization, if you want to, like for example, now we are doing biometric authentication. If you go back and build it all on the core, then it's too much overhead there, and it's too complicated, and in general, it's not even worth it. So moving that part out allows things like UPI to be a lot more modular, where we can innovate on the sides, and unless it's needed, you don't need to touch the core. It makes the job easier for banks, for companies like us, for the infrastructure providers as well.
So in some way, in that hollowing out the core strategy, payments is sort of always first, and it's always easiest to sort of get payments out. William, you were saying that even at the next step, you chose liabilities and said, these are the two parts, and you said, I'm going to build a specialized bank which chooses some parts of the bank core versus trying to be good at everything. How did you come to that choice? How is that working out?
I think one of the things that we've learned with technology over the past decade or two is the specialist win. Is technology is great about allowing you to go extremely deep and do one very detailed thing extremely well. But if you look at banking historically, they've kind of actually taken more of the Walmart approach, which is they kind of want to be everything to everybody. I think we kind of took the other approach, which is actually we want to do just a couple things really well, and then allow other specialists to actually build on top of us and do those things really well. And so, for our side, we started out from a payments and deposits, payments and liability side, which we are, I think, by far the best and most sophisticated payments and liabilities bank in the US. For lending, that's not our specialty. Like, we don't view ourselves as risk underwriters. There are other people for that. But we can focus on a couple things and build technology for that, I think, really well. And I think that is a relatively kind of novel approach in banking. Obviously, Razorpay and others, they've kind of taken that specialist and taken it outside the banking landscape. But especially in the US, the banking landscape is still kind of that full suite, full cycle, which I think will change.
So it's interesting, here in India, it's been payments, and after that, it's been a lot on the asset sides, which is co-lending and underwriting and so on, and not as much liabilities. Harshil, do you think there's something different where it is, after payments, go after the asset side of the stack versus the liability side of the stack?
Yeah, I think a lot of these things are being built, but at least in India, it's all happening independently in some ways, right? Yeah, there are companies trying to build, like, let's say, a super app approach to combine these together, but that's more from a distribution delivery perspective, not really from a tech build-out perspective. So you start with, let's say, from our perspective, like you start with payments, and we started with that, and we scaled a lot on that. Then we said, okay, from a distribution perspective, we felt that our merchants need a lot more. Our businesses need a lot more. They need banking. They need to do dispersals. They need to pay salaries. They need to pay vendors. So then we build the payable stack, which works quite independently. But from a customer perspective, it's quite linked because you collect money through payments. Then you want to pay your employees. You want to pay your vendors. You want to pay taxes. So we build that side where money comes via Razorpay, stays into a bank, and then use our technology or SaaS platform to disperse it out to different people. And then businesses also need loans, and a lot of people had a lot of credit demand. So we connected them to lenders where if you need a loan based on the data and everything that you have on Razorpay. We connect you with lenders, and then lenders can come out, give out loans to you. So while from a packaging perspective, it might look as one single solution, these are all being built independently, and over time, at least for us as well, it has been true that we focus on one problem at a time. That hey, let's go deep in payments. Now that we are doing this well, how can we help people do dispersals better? Now that we are doing this well, can we help them get access to credit as well? And each of these things themselves are still evolving and scaling up, but the packaging goes a long way in terms of getting customers to solve multiple problems in one single shop versus having to spread out across multiple different domains.
So a lot of the tech and the innovation that you guys sell is sort of invisible, right? Customers never see it. It's all incremental gains. How is that conversation within the bank? Like, how do you sell to the bank to say, hey, this is going to be incremental gain, but you guys know that it's going to move the needle a lot, and how do you get paid for it?
At least for us, I think, and this is internally our vision as well, I think the best payment experience is completely invisible. Like the ideal state of payments would be that, hey, you don't have to think, you want to buy something, you decide to buy, and it happens as seamlessly as possible. So, and that's where payments is a bit different in the sense, like the metrics that we will track will be kind of inverse of what a consumer company would track. So they want to maximize the time spent on the app, we want to minimize the time spent on our system. So we want to minimize the time it takes for people to spend on us. But what we measure is outcome metrics. So for us, when we talk to a business as well, what we measure is how much more business are you able to do because of us? How much time is it taking? If the time is going down, typically there's a direct proportion to more business being conducted on the platform. And same goes in our conversation with banks that, hey, if the time taken for this transaction goes down, if the latency goes down, there is an outcome metric, either in terms of volume processed or volume moved or dispersals happening, that typically goes up. And as long as the outcome metrics are moving up, the bank or the merchant gets convinced that, hey, this makes sense and we need to do more of it. So sometimes it's a bit of education, but a lot of times the outcome metrics are strong enough that the businesses care about that more than all the fuzzy stuff around it.
William, from your Plaid days, how did this conversation work? And I want to build on, you guys were both an API play, but also a platform play. How did you decide sort of pricing on APIs, pricing on platform, and making choices strategically around those?
I think from a company perspective, you have to understand, like, where are you going to make the large dollars? And sometimes if you're large enterprise software, you're going to make that initially by selling really large contracts. But for us, we actually knew that our business was very scale first, which is we had to get enough scale to actually start to increase prices over time. And so we actually gave the product away for actually relatively cheap for the first couple of years to get enough to make sure that every single fintech developer in the US was actually building on top of us. And after we had that kind of ubiquity, then we could actually focus on economics. It's a little bit different now at Column, where there's actually a little bit less scale benefits. There's less of a network that we're building, and the onboarding costs are quite a bit higher. And so then now I actually have to focus a little bit more like enterprise pricing, where I'm actually, the cost to do business is a lot higher. So they're a little bit different motion. I think the problem that some companies get in is they think they're this PLG motion. They think there's actually a lot of network benefits, and they don't actually focus enough on willingness to pay early on, and they have a hard time monetizing in kind of later turns. So I've kind of seen both. I think the PLG motion is definitely the sexiest. It's the coolest. People like it because you're gonna work with hundreds of millions of people. But you have to make sure the economics actually work well over time.
So I want to double click for the founders in the room and operators who are selling to banks. You heard like 2 or 3 really interesting things. One is always have the conversation on how the pie is getting bigger, and then you're getting that slice of the pie. And then from William, he was thinking very strategically about if there is scale, then I'll still make money sort of per API, whereas otherwise I'm actually looking for scale in each account, and then each account I'm going to maximize it. And often in pitches that I hear from bank tech companies, they don't think about either of these things, right? They don't think about this, how size of pie is scaling, or about how do I think about whether I'm an API play or an enterprise software play. Switching gears to a subject that I'm sure you guys spent a lot of time on, which is how much of your focus and dollars are engineering versus compliance today, and how do you sort of manage sort of the accelerator and the brake, if you will?
Yes, so, pretty much the only things I have to get right is compliance and engineering. everything else will kind of take care of itself, given our kind of narrow footprint as a bank. Compliance, I'd say it's probably about 45% of our spend, and engineering is about 45% of our spend. Because I think historically people thought, or fintechs had thought, hey, we're just going to move fast and break things. We're going to only focus on engineering. But actually what's happened as regulation has gotten a lot higher is compliance is actually a massive moat for you. A lot of people don't know how to do it well. Culturally, it's very challenging to integrate it well into your company. And if you can do that, though, it allows you to actually operate much faster in the outer years and actually have a massive moat that's actually harder for people to actually come in. So I think, coming from Plaid initially, when I started building inside the regulated bank space, it was actually quite challenging. I didn't really have a ton of experience there, but now it's something I think we do quite well, and it's a massive, massive investment. I sometimes joke, in the U.S., we have the Republicans and Democrats, and the only two things that they can agree on is that they want more regulation and they hate China. And so if you can kind of play to those two macro trends, you can be pretty successful.
Sorry, William, I'm just going to double click. I've been to your office. It's like this really nice, cool office right off Presidio. Yeah. And so how do you marry the cultures of this, fun engineering team and the compliance team? Yeah.
It is challenging, right? I'm not going to lie. But I think you just have to interview a ton. I'm sure Razorpay is probably the same way, that you end up probably hiring maybe 0.2, 0.5% of the applications you get in. And then for different areas like compliance or something like that, it's actually going to be a little bit lower. There are absolutely amazing cultural fits out there. There are amazing people who kind of migrate from banks to startups. You do have to interview a lot, and you do kind of have to pull people's natural tendency out. I think one of the things that we've found with a lot of compliance people is, there's a little bit of a harder shell sometimes. You really have to say, hey, no, it's okay to be your real self inside of a startup. Because if you work at a bank, it's sometimes a little bit more political, and so they're a little bit less willing to kind of wear their heart on their sleeves. And you kind of have to show them that, no, that's actually okay. That's actually what we want. It's okay to, lead in with emotion. I think that's always been sometimes the hardest transition.
Harshil, same question, compliance versus innovation, or compliance and innovation and the cultures?
Yeah, I think for us, at least over the years, to what he said, we realized that the compliance, for a fintech company, of course, compliance is a non-negotiable. You have to start with that. All kind of innovation that you do, if it goes against compliance, is going to be thrown out of the door, at least for any large fintech like us. So compliance is kind of like the starting point. It's like the rules under which you need to operate. And like you operate in terms of some market rules, compliance are the rules set by regulators in terms of under the boundaries under which you need to operate. So at least for us, if we talk about engineering and compliance, I think this is a dedicated compliance engineering team that we have, which specifically focus on building stuff on not just from complying from what is asked by us, but also how do we leverage compliance to innovate on top of it. So there are certain set of rules on, this is how you need to do KYC, this is how you need to do AML, and so on. If you can really put your engineering efforts behind it, you can find the most efficient ways to do some of those things. And to what he said, long term, some of those can start becoming a moat. So in a lot of things, we have seen compliance becoming a moat for us, that, hey, we are able to do the same rules that apply to everyone. We are able to meet those rules, but in a much more efficient manner, in a much more faster manner, or in a much more convenient manner to customers. And a lot of that happens because of the engineering team putting their efforts. Okay, these are the rules we need to hit, but what is the best or the most efficient way to hit these rules? Over the years, we have also seen, even in things like AML, which are considered completely like a basic thing that a business has to do to control the risk. Even on those sides, long term, we have seen there's a significant advantage to doing this upfront, because without, especially in a payment business, any kind of fraud flows or illicit flows and so on, quickly build a lot of unnecessary load on the systems, and then over time, when you notice them, then it causes a lot of backlash, not just from regulatory perspective, but from merchant perspective, consumer's perspective. And it's not in anyone's best interest, because you see some of those wrong numbers going up and you get excited about it, but then those fall down suddenly, and then you are in a pit because you can't get those back, and then you're in a pit because your growth has fallen flat, and it takes a lot of time to get back to that same level of growth. So I think catching a lot of these things early can be a good mode. A lot of largest fintech companies in the world have been killed by not doing these things right. There are thousands of examples in Europe and US, that companies who have died because they did everything well, they kept seeing the numbers go up, and when it came down, it came so rapidly crashing down, then it was hard to recover from it. So at least for a fintech company, and especially in payments, I think it's important to do these things early and think of these things as long-term moat, because if you want to be a large company, if you ever get to be a large company, doing this early is only going to help you. And And now, at least in India, with the pace at which this is taking up, it's not just unorganized risk. There are organized, there's organized initiatives around exploiting fraud, exploiting these gaps. So if you're not being careful upfront on taking care of these gaps, it's not a matter of will you be attacked, it's a matter of when will you be attacked.
I think one of the things around compliance as well is it's in many ways similar to engineering, where there's very little early payback period. Engineering, we're very used to R&D taking 2, 3, 4 years until it actually creates meaningful business value. And I think you have to treat kind of regulatory compliance and compliance in a pretty similar way, which is it's gonna seem just like this bottomless expense that is a drag on the company for multiple years. But really you should view it as this longer term CapEx and R&D investment that it is gonna actually create a huge amount of business value in 4 or 5 years. And I feel like sometimes a lot of people just look at it as oh no, it's just this cost center. But really it's just, as you mentioned, it's a massive moat. It just has a multi-year payback period.
Very well said. I just realized this while talking to you guys, so I'm going to digress a little bit off this tech path. And both of you guys are super young guys who sort of built these large businesses and have had a pretty successful track record of getting financial services folks to quit what they're doing and get them to come build this from the outside. What do you look for? And how have you sort of gotten these guys to come in, integrate with these teams, and so on?
Yeah, I think at least for us, over the years, so first of all, at least from my personal perspective, right, when we started in financial services, I think there was a bit of naivety as well. We didn't know how complex it is. Probably I wouldn't go back to study financial services today, but it's good to be ignorant, and it seems like, hey, how hard could it be, right? So over time, you of course learn that and scale that, and I think we've hired over time a lot of people, because now we know that, hey, there's a lot of experience, there's a lot of value to experience in financial services. We have had a lot of people who have experience from that domain, who bring in and explain to a lot of young folks in our, let's say, engineering team on what this means, how is it value accretive, what does compliance mean, for example, and what do these rules mean, and why do they exist in place. And at least for us, the thing that I particularly look for when we're hired from any large company, not just financial services, is people who are who want to do a lot and who are very excited about doing a lot, but are generally constrained by some of these large corporates because they want to move around and do a lot of things. So a basic rule of thumb is these are really good people and doing a lot of great jobs, but generally unhappy in their current roles. And those kind of people work best, because the primary reason they're unhappy in the current roles is because generally these, in some of these systems, they feel constrained that, hey, I want to try a lot of stuff, I want to move things around, but I'm constrained by what I can do. And when you bring such people into, let's say, a startup environment like ours, we see them move things around very, very rapidly and use all their experience to move these things around. And this is counterintuitive. Sometimes some of the most successful people in a typical corporate background might not work best in startup world, because the way they operate and what made them successful in those ecosystems doesn't directly translate to this. So for me, the rule is that somebody who's done well but is generally unhappy in those environments works well for our environments.
So since the time that I've met you, the one thing that's changed is you now always wear a jacket. Apart from that, how has the management style changed from managing your friends from IT Roorkee to actually managing all of these folks?
Yeah, I think it is quite different. I mean, when you're a 20 people, 30 people, 40 people startup, of course, there's a lot more excitement, a lot more energy, but a lot more informality in the way things operate. I think as the business is scaled up, of course, there's a lot more processes, a lot more structure. I think my personal viewpoint on how things need to be built and things need to be done has changed quite massively in the last 9 years of building Razorpay. And I think but I think the core tenets remain the same. So the 2 or 3 things that were core to us is this constant focus on speed. I think even today, my biggest worry or paranoia is in general, are we moving fast enough? Are we doing things fast enough, right? If something like GFF is happening, are we launching enough number of things, right? So that is generally one paranoia that I had in day one that continues to be with me today. Similarly, I think at least as we have grown mature, my worry on, hey, are we becoming content with where we are? I think that is one thing that keeps worrying me a lot more, that, hey, are we getting too content, that, hey, we have scaled up a lot and it's all going well. So I think a lot of those things have changed, and those need to change, because as you scale up, the success becomes its own enemy. And that's one thing that I constantly feel paranoid about. I think the other thing that changed a lot is now with a deeper understanding of financial systems, a deeper understanding of financial ecosystems, you understand a lot of value of the experience, especially on things like compliance, things like risk and things, and similar things. Like a lot of these things are not natural. So you can hire the best talented people, but if they've never seen cyber risk, if they've never seen fraud, if they've never seen compliance closely, it's just not natural for people to just build it from ground. So your first principles approach can work for engineering, for product, for even for sales to some extent, even marketing. But things like compliance, risk, these are things that you learn by falling. So if you've never seen a big fraud happen, if you've never seen a compliance issue happen, it's really hard for you to predict where those gaps could be. So in some of those areas, I think you've learned that, at least I've personally learned over the years, that the experience carries a lot of value, because people who have seen and closely seen some of the worst things that can happen when you don't do these things right are the people who will avoid you from making the same worst mistakes.
I think one of the hardest things to learn when you operate in financial services, it's pretty similar to what you said, is when do you think from first principles, and when do you say, oh, this has been done for the past 20 years this way, it must be right. And I think startup people, when we're young, we build technology, we're like, oh, everything is wrong, everything is broken, we have to start from first principles and reinvent the world. And that's right about 50% of the time. And I think sometimes people from banks or kind of more other companies are like, oh, well, I've seen it done this way, I'm going to copy. And the honest answer is it's kind of like half and half. And so like the hardest skill set is understanding, okay, when is right and when is wrong. Definitely not perfect, but I think for me, I think from a maturity perspective, being able to differentiate and say like, nah, this one, no, let's start from scratch. This one, all right, let's like trust the old white guy, you know? Like, how do you think about those two?
That's awesome, guys. I really enjoyed that insight into how you're building the companies as well as the orgs. I'm going to try and get us back on track on the future of bank tech now. When you think of the overall payment stack, it's created this enormous surface area, and that obviously leaves us vulnerable for attacks in India, and it's the same with the US and so on. For someone who's a layperson, how do you explain how much the surface area has increased and how sort of vulnerable we are first, Harshil? And then how do you, what steps are you taking in specific to make sure that you're actually secure against some of these attacks?
Yeah, so I mean, India is the largest payments market in the world, and from that perspective, as this payments ecosystem has grown, of course, cyber crime, frauds, and everything has grown with it. We are still one of the lowest incidents of frauds in the world, like if you look at it from percentage terms. But I want to call out that we shouldn't get blindsided by that, hey, the percentage is low, so it's all fine and good. The challenge in India is that while the fraud overall percentage might be low, it uniquely targets the bottom of the layer of India. So from your mind perspective, like the volume of this fraud is extremely low. Average size of fraud might be like 50, 60, 100 rupees, and we might say, hey, it's really small. But when you look at this, uniquely targets the lower segment of the population, which is not as educated, not as digitally aware. And we look at from their perspective, that small value of fraud could be life-changing for a lot of those people. So it's really important to target that and constantly focus on solving that. So instead of looking at aggregate numbers, we have to look at the segment of population that's attacking and how relevant it is for them. Now, from that perspective, right, as I said, like initially it started with unorganized fraud where people were getting OTPs on phone and stuff like that. I think now there's enough evidence that most people don't give out OTPs, so it has gotten more sophisticated over time. We have things like FedEx scam and so on, where people are like doing full. I had a friend who was on a call with this FedEx scam guy recently. He was telling me that there was at least a 2-hour call before the person asked for money. So it was 2 to 3 hours. The guy spoke on the phone, then connected with the fake policeman who did a video call. Then he actually ended up asking money in some convoluted way. So they're getting more sophisticated. They understand that if you call a person and ask for money upfront, most people will turn it down now because people understand that, hey, don't give OTP on the phone. But now they take a lot more effort to get to that level of fraud. It's getting more sophisticated, which makes it harder and harder to prevent. And now with advent of AI, we'll see how this evolves further and become even more unsolvable. So from a payments perspective, I think some of these attacks are easy to block. The lowest hanging fruits most companies have done, and that's sorted. But now these are more sophisticated kind of frauds coming in where your customer really wants to insist that he wants to pay. Our risk team has been in call with customer where we blocked the transaction because we knew it was fraudulent. The customer called up and said, I really want to pay. And we knew this is fraudulent, but the customer is insisting because he's worried that he's getting arrested or something and he needs to pay right now. Now, those are hardest to block because the customer is insistently wanting to pay. Of course, 2 days later, he'll come back and file a chargeback, which we'll have to manage. So getting to those level of fraud, I think the best way we have seen now is like data is the best way because the typical, again, first principles approach of blocking fraud are done. That doesn't work anymore. You need to use data. You need to use a lot of sophisticated tools. We use a lot of in-house and external tools, and the combination of that to find out the incidents of fraud. I think as the scale rises, it becomes also easier. For example, we have about 5 million merchants on the platform. So now when a customer does a fraud on one merchant of ours, we know we block and blacklist it across the platform. So when the same guy tries to attack another merchant of ours, we know we are able to prevent it. So the incidence rates goes down over time. There's a lot of heuristics built now because we are seeing how customers transact across all our merchants. Like, how do they scroll through that page? How do they click? How do they pay? So our systems are able to detect that somebody who didn't look at the product page at all and just clicked pay as soon as they landed is most likely a fraudulent customer because most real customers will generally scan and see what they're buying before they buy. The speed to entering OTP, the speed at which they are completing a transaction, all of those things are important factors. And now with technology, we have enough data in each of these steps that we can figure out what is the average and what is an anomaly, and use that as a way to detect and block it. Of course, now with AI, we are like AI is a boon as well as a bane. So AI also works on this side and helps it do it even one step ahead. So far, what we are able to do is see one kind of fraud happening and then avoid it from recurring again. AI allows us to predict it, so prevent it from happening for the first time. Basically, use the heuristics to say, hey, this looks like it's going to be a fraudulent order, and without ever seeing this kind of fraud happen again, how can we block it early? So some of those, like as the fraudsters are getting sophisticated, some of those tools are getting sophisticated as well, and I think it's going to be, it's who is investing the most in solving it first. And I think as long as fintech companies are the ones taking the lead on solving that, you will be able to block it. Otherwise, the fraudsters are anyways investing in it.
William, any thoughts on how you used to think about, I guess, fraud as well as cybersecurity when you were at Plaid versus now that you're sort of a bank?
Well, it's just a little bit interesting. I think sometimes we mix up, like fraud and cybersecurity. And I think when outside the regulatory environment, you're mostly focused, what you talked about is about losses. It's about, hey, how do I prevent bad actors from abusing my platform for something? Once you decide into the regulated market, there you actually mostly focus on InfoSec risk. And the interesting part about that is you're kind of optimizing for two things, right? Like when I initially started, I was like, oh, the only thing that I should care about is keeping bad actors out of my platform. But then you also have to think about, well, how do I actually communicate that in the way that the regulators understand and protect the risks that they care about? And you want to think it's a perfect world and it's both the same thing, but it's actually quite different. And I think early on, I kind of was always a little bit more first principling in InfoSec, and I was like, no, this is like the right engineering way to solve this problem. And then now I think I've gotten older, it's a little bit more like, okay, I'm going to do that, but I'm also going to do it in a way that the regulators can understand that it's kind of the way that they can go back, inform their colleagues, hey, they're above board, they're doing it in the right way. I think that's been a bit of a mind shift, which is you have two audiences, and you can't forget that the regulators is, in many ways, just as important as actually protecting yourself.
So let's talk about hopefully some fun stuff around what's happening in the AI world, especially within your companies. I'm sure you have engineers running around running inference models on all sorts of data that they have access to. So one, what's like a really fun project that came out in a hackathon which sort of blew you away, saying, hey, I didn't think our company could actually build something like that. And then second, where do you think it's sort of most applicable within your businesses?
I think from my side, I think this is probably like across most enterprises, that like coding advancements is by far the most applicable and highest ROI area for us at least, which is I think your average engineer is probably 30 to 40% more productive because of LLMs. I think that is probably still going to be the main actually ROI driver for most of tech and most businesses for the next little bit. I think the other area for us that has been actually quite helpful is like data structuring, which is, data normalization is like a very unsexy, but actually like quite hard problem. And whether you're doing it for fraud, whether you're doing it for inference or anything, like the structure, and the structural consistency of that data is extremely important. And especially when you're pulling in a bunch of data from third parties or for consumers or something like that, that structuring and kind of like the static heuristics that we used to use was, it'll only maybe get to like 70, 75% accuracy. Now with LLMs, I think you can generally get it for like 90, 95% accuracy, which helps your baseline models a lot. I'm a huge, I'm a huge bull for like AI from like a engineering. It's super fun, it's super sexy. I'm relatively bearish for it actually having a lot of like near-term implications for businesses outside of coding, outside of data, maybe a little bit of fraud. But that's just me.
Yeah, I think there are multiple areas where at least we are seeing AI come on in various ways. You're right, I think engineering efficiency is the most high ROI thing. But from a customer lens, I think one area that we've seen is as a B2B company, we need to give a lot of support and help to our merchants, especially when they want to integrate and so on. We recently showcased Ray, which is our AI bot, which allows people to write code like they put in their website that, hey, I'm building a Python website, I want to integrate Razorpay, and it generates a code specifically customized to their ask. It can do it, and while we started with that we wanted them to generate code and use code generation, but it's a generative AI, it can answer all sorts of questions. So we were surprised when somebody asked him, hey, my settlement hasn't happened today, what can be the problem? And it had access to the backend, so it looked at that and said, hey, your settlement is not working today because it's a bank holiday. But then it suggested, and this was something we never programmed, it suggested that, hey, Razorpay has instant settlements, why don't you try that? And that was something that really blew me, that that's what differentiates our generative AI system, that it can do things that you're not predicted, it can do things that you're not planned out, and it started giving those suggestions that like my average support guy would probably also not give. The other side that we are seeing is on the fraud protection. So initially we used it for our fraud protection, but then we got so much confidence on it over time that we started deploying it and making it available to our merchants. So now we offer merchants fraud protection using our AI engines, where we say that, hey, we will deploy this AI fraud protection for your systems. And if a fraud happens after this, we'll cover the cost of it. So that's something unique that we are able to go out and deliver, because the kind of fraud protection that an AI engine can do, even merchants themselves can't do manually. And those are some of the best examples that we are seeing going out in the field and solving it for a problem for merchants, especially on the international payment side, where fraud is extremely high because of non-2FA. The AI fraud protection system is able to block it and reduce anywhere between 5 to 10% fraudulent orders for an average merchant. The last thing that I see a lot of AI being used in our team is on the marketing side. The amount of effort it takes to generate collaterals, to generate a lot of stuff. For example, if you go to the Razorpay.com homepage, most of the central images that you see, we have customized images of a lot of our merchants, like let's say a Fool co-founder and the Mamaearth co-founder and others. All of it is being real-time generated by AI. And that is possible in this day and age, otherwise it will take months to generate each one of those. So I think AI is again, such a base technology that it's going to get applied to almost every domain. I think we're still learning. We've probably scratched 1% or 2% use cases on what all it can touch.
How do you organize some of these experiments internally?
Yeah, so we have initially we started thinking of AI as like one specific stream, but I don't think that's the right way to look at it. So you can't look at AI as one separate stream like marketing or sales, that, hey, these are 5 people who will do AI in a company. It's like how earlier people wanted to digitize themselves and they created like a 5-people team, that these 5 people will do digital and rest things done themselves. AI is like that. You need to embed it into every team. So we created like what we call an AI council, where every team submits what all can AI do in their ecosystems, and then the council centrally owns like driving different initiatives across different teams. So the execution has to be owned by each team, and that's why we had to train almost entirety of a workforce on AI. So we didn't just train engineers, we did like AI training across of entirety of a workforce, that everyone from my marketer, from my sales guy, from my ops guy needs to know how to leverage AI today. Because otherwise you're not operating at your best, and if somebody else on the other side is operating using AI, they're going to beat you. It took a lot of time, but it is worth it.
That's a great way to think about it and also implement it. I think we're almost at time. So last couple of questions for you. Harshil, for you, now, you're a founder in the audience. Now you've seen all of these big incumbents, build tech, including you now. How would you approach the landscape in terms of choosing a problem to build in, and then figuring out how do I think about GTM and sort of scaling?
I think for me, it's fairly simple. Like it comes from the YC principle of make something people want. So I, on an average, meet at least one customer a week, and that is generally my testing ground of whatever strategy, planning, and decision we are taking in our office. Like one conversation a week, at least with a customer of mine, is my testing ground of whatever are we thinking. Are we in the right track? Are we in the wrong track? It doesn't mean build everything that somebody asks you to build. But it's more like learning, okay, this is what we are thinking. Is this making sense for you? Is this not making sense for you? And just constantly testing that. I think that's generally the best answer. And the advantage for us as a B2B company is it's not very hard to meet our customers. They're generally limited in numbers. They're generally in limited cities. It's easy for me to pick up the phone or get into a meeting room and just speak to them directly. So I think that's generally my barometer for figuring out what next to build out.
Well, as the guest, we'll let you have the last word. You've come in, you've seen this, pretty big fintech ecosystem. What are things that you find sort of the most amazing, and what are risks that you see from the outside?
I mean, the reason I'm here is I think India is the most interesting financial market in the world, bar none. I mean, from an infrastructure perspective, it has the best financial infrastructure, has the best identity infrastructure. It's absolutely incredible. I mean, the U.S. obviously has the deepest and most liquid capital markets. That is our major benefit. But as you think about from an identity and payments perspective, we are so far behind. I think the one thing, if I'm going to be honest, is I think the fact that most of the infrastructure is provided top down, it doesn't leave a lot of margin, I think, for the private sector. I think that the benefit that I do have in the States is my competitor is not the government. And anytime you try to compete with the government, it's a relatively challenging area. And I do think the thing about India, which will be interesting over time, is where is the money? Where is the area for actually private businesses to provide enough value to actually charge enough money to make hundreds of millions or billions of dollars of revenue? I think there's definitely some clear opportunities in India, but I think it's very different than what it looks like in the US. And I think that is like an interesting thing, which is like why you probably haven't seen a lot of cross-pollination between Indian financial services and US financial services, because the go-to-market and the actual margin perspective is fundamentally different. I'm relatively happy to be in the US, but I think probably people in India would say the same thing as well.
That seems like a great note to end on. Guys, thank you so much for the time. I really enjoyed the conversation, and hopefully the audience did as well. Thanks.
Thank you.